Yes, students of CPA, it's another perfect morning we meet for our session, for our theory session of these students of CPA. It's another So I was saying that it's another perfect morning we meet for a session of financial reporting and analysis, of which I will be looking at the theory part for December. Theory part for the December, that is December 2024. December 2024 Kasneb exams. Theory part of it. So only the theory questions for these December 2024 Kasneb exams. Financial reporting and analysis. So I will be sharing those notes on the screen so that we go through them. So I've already solved them. We want us to go through how you are supposed to answer the theory part of it. So this is the relevant exam for our city. That is CPA intermediate level, financial reporting and analysis. It was done on Wednesday 4th, 2024. It's a morning paper. Answers to theory questions. Question number one. Question number one was based on IFRS 9. So you were told that with reference to IFRS 9, financial instruments, recognition and measurements, explain the following ways of measuring financial assets that are invested in debt securities. So explain the ways of measuring financial assets that are done what? That are investments in debt securities. So the first one, it's all about at amortized cost. So when we talk about at amortized cost, we say that for investment in debt that are measured at amortized cost, the asset is initially done what? Measured at fair value plus transaction cost. So that is at amortized cost. The investment in debt securities that are measured at amortized cost, the asset is initially measured at fair value plus what? Transactions cost. So interest income is calculated using investment. That is an effective interest rate. The interest income is calculated on what? Is calculated using the effective interest rate. The second one was at fair value through other comprehensive incomes. So when we talk about at this fair value through other comprehensive incomes, we say that for debt investments measured at fair value through other comprehensive incomes, you say that the asset is initially measured at fair value plus transactions cost. It's okay. The interest income is calculated at effective interest rate. Then finally, we say that at the reporting date, the asset will be revalued to fair value with the gain or loss recognized in other comprehensive incomes under items that will be reclassified to profit or what? Profit or loss. Then the third one is all about at fair value through profit or loss. For this one, for the debt investment measured at fair value through profit or loss, the asset is initially done what? Recognized at fair value with any transactions cost charged to profit or what? Profit or loss. Then at the reporting date, the asset will be revalued to fair values with the gain or loss recognized in the statement of profit or loss. That was the first question, question number one. The theory part of it was having 6 marks. And those are the points you are supposed to give. Those are the points you are supposed to give to get the 6 marks. Question number 2 was according to IFRS 4, whereby they say that the effect of change in foreign exchange rates provide clear guidance on how entities should translate monetary items and non-monetary items, as well as treatments of the resultant exchange differences. So the effect of changes in foreign exchange rates provides clear guidance on how entities should translate monetary items and non-monetary items, as well as the treatment of the resultant exchange differences. With reference to that, with reference to the above statement, explain how monetary items and non-monetary items should be translated and the treatment of their respective exchange differences. So when we talk about monetary items, shall be translated using closing rates. Should be translated using closing rates, which is a split exchange rate on the reporting what? On the reporting day. So you translate monetary items using the closing rate, which is the split exchange rate on the reporting what? On the reporting date. So the resulting exchange differences, when you translate, the resulting exchange differences shall be recognized in the surplus or deficit for the period. So what about non-monetary items? Are measured in terms of historical costs. Are measured in terms of historical what? Historical cost in a foreign currency shall be translated using exchange rates at the date of transaction. At the date of what? At the date of transaction. Where such assets are measured at fair value, they should be translated using exchange rate at the date when the fair value was determined. Exchange differences relating to non-monetary items may be recognized either in the surplus stroke deficit or in the net asset stroke equity. So also that was question number 2, 4 marks. So that is how you are supposed to translate monetary items and non-monetary items. So which monetary items we have said translated using closing rate, and here we have grouped that non-monetary items, whereby we have said that measured in terms of historical cost in a foreign currency shall be translated using exchange rate as at the date of the transaction. Where such assets are measured at fair value, they should know they should be translated using exchange rate at the date when the fair value was determined. So that is so far 4 marks. So 6 plus 4, that is 10. Question number 3. Outline the accounting treatments of a government grants related to income in accordance with IFRS 20, accounting for government grants. So treatment of government grants. Treatment of government grants. Number 1, we say that IFRS 20 states that government grants should not be recognized until the condition to receipt have been complied with, and there is reasonable assurance that the grants will be received. So government grants should not be recognized. They should not be recognized until the conditions for receipt have been complied with, and there is reasonable assurance that the grants will be received. So grants should be merged with expenditure towards which they are intended to contribute to the statement of profit or loss. So they should be merged with expenditure. They should be merged with the expenditure. The number 3, income grants given to help achieve a non-financial goal, such as job creation, should be merged to the cost incurred to meet that goal. Then finally, point number 4, grants related to income can either be presented at credit in the statement of profit or loss or deducted from the rated expenses. So government grants. So those are the 4 points. So that is 4 marks. So far we are at 6. We are at what? 6 plus 4, 10. 10 plus 4, 14. Then question number 5. Because for question number 4, there was no theory. That is the only question which will be remaining. Question number 4 is published. I think so far, that is the only question which we have not tackled there. Because now I have done question number 1, 2, 3, and 5 fully, because I'm now covering the theory. So the only question which could have been, which was not having theory, is question number 4, 20 marks. I will be able to do it next time in class. I will be able to do it in class. So number 5, the last one, in relation to international accounting standards for tour and agriculture, explain the following: recognition of biological assets. How we recognize biological assets? So we say that biological assets are recognized when an entity controls the asset. When the entity controls the asset, because of the past events, and it's probable that future economic benefits will flow to the entity. The return, that is, future economic benefits will flow to the entity. So controls involve the power to direct the activities that significantly affect the biological assets' ability to produce. So the entity should assess whether it can make decisions about the assets' agricultural production activities. Like now, if you are doing livestock farming, if you are doing crop farming, so For the recognition of those relevant activities you are carrying out, those are the relevant biological assets, the living plants and animals. We have said that the recognitions when an entity controls, so you recognize, I recognize when an entity controls the asset. You have the ownership because of past events, and it's probable that the future, that is the return, future economic benefits will flow to the entity. So controls involve the power to direct the activities that significantly affect the biological assets' ability to produce. Are you capable to get the return? Are you capable to get the, do you have power to make sure that from the activities you are carrying out, are you getting the relevant production? So, and the entity should assess whether it can make decisions about the assets' agricultural production activities. So that is recognition. For measurements of biological assets. So IS 41 prescribes the fair value model for measuring biological assets. So we use the fair value model for measuring the biological assets. So fair value is determined based on the market prices. If an active market exists, if an active market then exists. Otherwise, valuations techniques are applied. So otherwise, the valuation technique are applied. So the fair value reflects the entity's expectation about future cash flows. So the fair value reflects the entity's expectations about future cash flows, including expectations about biological assets production and its market values. So the fair value model, for fair value model is determined based on market prices, if an active market exists. But otherwise, we use the valuation technique. So that is the measurement. So after recognition, we have looked at measurement. So then B, explain two types of post-employment benefits plan in accordance with IS 19 employee benefits. So two types of post-employment benefits. So the two types of post-employment benefits is talk about the defined contribution. We talk about the defined contribution. So this is a post-employment benefit under which an entity. So this is the first one, defined contribution. And the second one is this one, defined benefit plan, defined contribution and defined benefit plan. So we explain the first one. So explaining the first one, we say that when talking about the first one, we say that this is a post-employment. This is a post-employment benefit. The defined contribution, it's a post-employment benefit under which an entity pays fixed contributions to a separate entity. So an entity pays fixed contributions to a separate entity, that is fund, and the entity will have no legal or constructive obligation to pay further contributions. It will have no legal or constructive obligations to pay further contributions if the fund holds insufficient assets to pay all employee benefits relating to employee service in the current and prior periods. So IS 19, under this, when an employee rendered service to an entity, when you provide service now, let's say you have someone, you have been working somewhere. So when an employee rendered service to an entity during the period, the entity recognizes the contribution. The entity recognizes the contributions payable to a defined contribution plan in exchange for that service as a liability, and that is accrued expense and as an expense. Then the second post-employment, the second one is defined benefit plan, of which we say under this plan, the benefits payable to an employee are not based on amount of contributions, but are determined by terms of defined plan. So benefits payable to an employee are not based on amount of contribution, but are determined by terms of the defined plan. So under IS 19, the entity uses an actuarial technique to estimate the ultimate cost to the entity of the benefits that the employees have earned in return for their service in the current and the prior periods. So that was the theory. So this is how many marks? So this is 4. So the theory for this sitting was having how many marks? So the marks, so we have 4 plus. So question number 5 was having 4, talking about IS 19 and also talking about biological assets. the biological assets, 2 plus 2, that is another 4. So we have 8. Question number 5 was having 8 marks. Question number 3 was having 4 marks. This is question 5. Question number 3 was having how many marks? 4 marks. That is question. That is 4. Then we have question number 2. Question number 2 was having that is 4. Question 2. That is 4. Then question number 1 was having 6. 2 plus 2 plus 2. That is 6. Question number 1. That is 6. So for that relevant sitting, the theory only. The theory was having how many marks? So this is 10, 14, 22. Having 22 marks. Was having 22. So I've done the theory part of it. So the only question remaining for that sitting is question number 4. So the published financial statements. Preparations of the statement of profit or loss. So we'll be looking at in our next live session or under my Zoom classes. We'll be looking at on how published is done, of which here they were talking about statement of profit or loss, statement of profit or loss, statement of changes in equity, statement of changes in equity, statement of changes in equity, statement of changes in equity. Then we talk about statement of financial position, statement of financial position. So to mention a few, when you are preparing this, under the statement of profit or loss. So the main thing you need to know under statement of profit or loss, under the statement of profit or loss, under the statement of profit or loss, it's all about the classification of what? Classification of expenses. Classification of expenses. So which expenses are classified based on various functional heads? So you classify expenses based on various functional heads. So expenses are classified under cost of sales. Some expenses go to the cost of sales. Cost of sales. Some expenses are classified under admin, that is administrative cost. Some expenses are classified under distribution cost, under distribution expenses. Then finally, some expenses goes to finance cost. Finance cost. So they will be able to guide you under the additional information. Maybe some expenses goes to this and this, or you need to know. Ignore the cost of sales. You will find that mostly depreciations are classified under the cost of sales. The depreciations are classified under the cost of sales. And another cost related to sales. Administrative, these are expenses classified under this. They are what? They are expenses which are directly related to the management of that relevant business. So right now, we have things like if you are paying your directors emoluments, if you are buying stationery, if you are, anyway, administrative cost, administrative expenses in nature, distribution, like now if you are advertising your products. So advertising goes to the distribution. Carriage outwards, expenses that carriage outwards goes to distribution. So for finance cost, this is interest. So when you are giving a loan, the interest expenses are classified under the finance cost. So the main thing under the statement of profit or loss is the classification of what? Classification of those expenses. Once you classify well, once you do your additional information, then you classify well, you can be able to do your question. Then you need to know the format now, how it goes from there. Sales, less cost of sales, add incomes, less expenses. So the expenses are admin, distribution, and finance cost. Then you less your tax, you get profit for the year. Then if there's other comprehensive income items, like now the revaluation. If there's revaluation, remember revaluations of tangible assets are classified under other comprehensive incomes down there. And for the changes in equity, remember this one pertains the change in equity component, like now ordinary share capital, share premium, and the rates of retained profit, they change. So also you need to know how the format goes. So for statement of financial position, here you look at non-current assets. You look at non-current assets. You look at the non-current assets. So under non-current assets, we have tangible assets, tangible non-current assets. So the tangible ones must be classified under property, plant, and equipment. We call it PPE, property, plant, and equipment. So tangible non-current assets must be classified under PPE, property, plant, and equipment. They must be classified under property, plant, and equipment. Then the other one is just checking if there's anything to adjust based on the additional information provided. So students of CPA, I think it was a nice session today, a short one. I wanted mainly to cover the theory part for the December 2024 Kasneb exams. We have done. I have seen that it was having 22 marks. 22 marks are a lot. Even if you get 15 out of the 22, you are okay with that. If you get 15, now from the other computational areas, you look for the 35, because the pass mark is 50%. The pass mark is 50. So whoever wants to join my online classes, the Zoom, you know that I do the Zoom classes. The Zoom classes whereby we can be able to interact virtually. You can reach out. You can reach out. You can WhatsApp me or call through this number. So that is my contact for whoever wants to join my Zoom classes, online Zoom classes, the virtual online classes. So the virtual classes, that is, say online, it means virtual. Online Zoom classes. So you can reach out through this number, so that we can be able to agree on the way forward. So thank you for attending today's session, and we have come to the end of the session today of covering the theory part of December 2024, theory part of December 2024 Kasneb exams, financial reporting and analysis. Welcome. You can be able to reach out through that number so that you can be able to enjoy the other classes which I do during the evening, that is 8 p.m. to 10 p.m. So that is the end.